So welcome to this complimentary webinar entitled How Professionals Avoided the 2020 Correction. My name is Marshall Beyer, and I am a Senior Director at the Canadian Securities Institute. And I will just take a moment to introduce the star of the show, Lloyd Williams. Lloyd is founder of the Mastermind Group, an elite collaboration of investment professionals and traders. He has trained himself with some of the best professional traders in the world and brings a very unique perspective, having managed retail portfolios and institutional pools of money for Goldman Sachs, and as well as been a hedge funds trader with a focus on futures. Since retiring quite young, I may add, from these roles, he has been involved with both coaching and training financial advisors and others throughout North America for the past 20 years. I know some of you have already benefited from Lloyd's teachings with some of the large financial institutions here in Canada. Lloyd was introduced to, CSI was introduced to Lloyd early this year, and we enlisted him to conduct practice management type webinars that CSI offered as a way to help and provide support to our designation holders and broader investment community during the worst of the pandemic-related market meltdown. We were extremely impressed with Lloyd's unique approach and passionate delivery, and from the feedback we received, so was the audience. As such, CSI has worked with Lloyd to support, endorse, and bring his expertise and vast library of content back to our constituency, starting with today's webinar, which will give you a good sneak preview of his full-blown Trade Like a Pro course, which is to be delivered starting later in September. Whether you are relatively new to the business or have been around a long time like me, this training will introduce different and unique ways of looking at markets and your practice, which in the end will provide great benefits to you and your clients. So without any further ado, here is Lloyd.
Thank you, Marshall. And welcome, everybody. Throughout the webinar, if you have a question, please enter it in the Q&A. It should be at the bottom middle of your screen. You should see the Q&A button. If you can't, move your cursor down there and it should pop up as a button. Please enter any questions you have throughout the webinar and you just put them down there. I will answer them at the end of the presentation. All the questions that are put in the box will be answered. If they're not answered live today during the call, we will send out a follow-up email for all the additional questions and get those answered too and send it out to everybody so you have a question. And we have here, if you have a question for CSI, Marshall will be happy to answer it. If you have a question for sort of the process and the system stuff, Colleen, my online business manager, will be happy to answer. And if it's about the course or about the content of this webinar or about the practice or investments, then I'll be happy to answer it. Now, my goal today is to illustrate why building a professional practice that exceeds your client's expectations is more important today and easier to accomplish than ever before. Everyone is here for a different reason. You may have seen a concept or an idea in one of the emails that was sent out that captured your attention. Your reason is unique to you and to your practice. Now, some of you want to gather more assets or grow your assets so that you can grow your business. Some of you want to capture more opportunities that arise day to day. Some of you want to separate yourself from the herd of all the advice out there in the industry, both online and the like that exists today. Some of you want to take back control of the investment process that you may have outsourced to other sources. Some of you would like to be more proactive in your life with your clients. Some of you want to minimize your clients' losses, like the endowments and the foundations and the hedge funds have done for decades. And some of you may just want to fine-tune an already successful practice so that it becomes more of an autopilot business. Now, to help us sort of understand where everybody is in this, I'd like to take a quick little poll and just see where everybody is. Take and answer this poll and just answer however many questions are relevant to you, whichever ones, mark as many as you want to. It's a multiple choice. So let's just take a quick minute here and everybody just click on the button, which ones is the reasons why you are here, so I can have a little better idea of where everybody's here. and we can focus our attention. We're going to take just a few minutes, a couple more seconds here to do this. So if everybody could quickly do that, we'll sort of get this, get a read on how everybody's here for. We'll go another few seconds here. We've got about 75% of everybody have replied so far. Okay, looks like it's slowing down. Okay, so let's end the poll here. We'll give it 10 more seconds. 10 more seconds if everybody make up your choices. Okay, so let's share the results here. So number one, capture more opportunities is the biggest thing, followed by be more proactive and gather more assets and separate yourself from the herd. So let's go here. Okay. Now, one of the things that's important here to look at this here is it's surprising that all of these concerns relate to one specific thing, the desire to be unique. Every one of them in some way, it separates you from everybody else. To stand out from all the myriad choices clients have today to choose between. You've got the institutional players reducing their minimum account size and sort of dipping down into the top of your book. The robo and Finet solutions are coming up from the bottom end and trying to take care of clients' needs on the internet. So practices are sort of being squeezed in the middle. But you have one significant advantage over every other solution in the financial service industry. You have a personal, unique relationship with your clients. This relationship gives you a competitive advantage in the marketplace and is the single most important thing you need to protect in your practice. Some of you today are solo practitioners. Okay? Some of you have large teams that you manage. Some of you have successfully maneuvered through the peaks and valleys of the market as it's fluctuated. Others of you are concerned over the losses your clients incurred earlier in the first quarter, and you may be fearful of what may come around with the next correction. Today, we're going to look at 4 ways professionals have built a story that attracts new money, have managed proactively their clients' expectations, have created a rule-based practice to make better decisions, and how to protect their clients' assets. Now, I've had the unique opportunity to manage institutional pools of money, retail portfolios, and hedge fund futures accounts. So when I talk about professional management, I'm talking about institutionals, endowments. When you hear the word endowment, think university foundation portfolios and hedge funds. These are 2 ends of the big player perspective. The endowments on one side, the big institutional players on one side, and the hedge funds on the other. We're going to look at the difference between them and how they connect together. What we're really discussing here is how to incorporate from these 2 players that are doing it professionally and doing it well. What's their best practices? What do they have that the retail portfolio managers in the past never had? Because technology and the times have allowed and opened the doors up that you now have access to everything they have access to. And that's a game changer. Now let's take a moment and look at each of these 4 in more detail. First, professionals build a story. Professionals understand the importance of story. They understand it both from a marketing standpoint in terms of gathering assets in, and they understand the necessity for a story in terms of client retention and keeping the assets they already have. Now, whether they manage an endowment at a university or whether they manage a hedge fund, they know that recent changes in the market require a better story. We have seen new technology and better tools that now allow us today to manage the retail assets just like an endowment or a hedge fund. Not only do we have better tools today, but the speed and volume have dramatically increased, significantly so. Professionals know this requires that they build a better story than their competitors. Now, increased volatility and fear require us to spend more time and effort explaining things to our clients. This is a problem for everybody. It's also a necessity for the individuals out there, the individual managers. Professionals know that this is an opportunity to elaborate the importance of their risk management focus. Now, again, this gives them a better story because institutions primarily focus on the risk side more so than the profit side. They assume their profits are going to come by avoiding the losses rather than having to address them and deal with them. In addition to this, computers have permanently changed the markets worldwide. Computers like trading ranges, and this is radically different from times in the past. This chart you're looking at here looks very different from what it would look like pre-2000. And the reason is computers prefer a trading range because they can make money in both directions. Why is this a concern for us? Because the retail investor typically only makes money when the market goes up. Professionals take advantage of trading ranges to increase the profits during this period of consolidation because they can get paid multiple times to cover the same territory. And again, this helps them build a better story. Now, it's important to look at your story. Take a moment this week and write out your story. How is your process or solution unique in the marketplace? How have you adapted to take advantage of the recent changes that have occurred in the marketplace? How are you adopting new technology and new tools into your practice? How does your process better manage the increasing volatility to reduce risk? And how are you maximizing the influence of computer trading to benefit and not be run over by it? Ask yourself, does your story give you a unique edge in the marketplace, or do you just look like everybody else around you? Change brings opportunity. And this last decade, we've seen significant change, which for us means significant opportunity to be unique and to separate ourselves from the herd around us. The first way for professionals to be unique is to build that compelling story that better aligns them with the counterintuitive mindset of the marketplace and the markets themselves. This gives them an edge. Now, in the upcoming Trade Like a Pro course, you will build your own unique story that aligns with your investment process, your unique investment process, to create an edge in the marketplace. Now, secondly, professionals manage proactively their clients' expectations. Professionals understand that the increasing volatility of the markets both scares and excites clients. Clients fear the possible losses, and many lose sleep over it. And they are also excited about the potential profits as the market continues to go higher and higher. Clients have come to believe all boats float in a rising tide, and everyone looks good. But professionals know that anything can happen. You don't have to know what's going to happen to make money. Eventually, the tide drops and all those riding the tide fall. But they don't have to. Professionals use a risk-based safety net to avoid the declines. That's one of the biggest differences between the institutional endowment portfolios and hedge funds and the retail markets is the professionals basically avoid a significant portion of the declines in the marketplace because of the risk management tools they put in place. Now, where do you go when stocks are unfavorable? Do you get defensive and buy utility stocks, or go into bonds, or buy more conservative dividend-paying security stocks? Or do you go to cash? Professionals don't do that. Endowments, foundations, hedge funds avoid the major corrections by managing expectation before the correction, and then adapting the portfolio to align with the structural changes in the market itself. It's no longer a look for a defense, a stronger defense. They don't want a stronger defense. They want a stronger offense. Take some time this week to look back at the major market corrections that have occurred during your career. Calculate how much larger your assets under management would be today if those losses had been avoided. Ask yourself, do we currently have a safety net or a plan to do something different when the next correction occurs? Because there will be another correction. There always is another correction. How will your clients respond if you were able to avoid that next correction? Endowments, hedge funds have consistently outperformed the markets and avoided losses for decades by incorporating a better risk management model in managing expectation. And so can you. Professionals know the best time to prepare for a correction is before it occurs. Risk management is not put in place during a correction. But in the clear light of day, risk management is done before the correction occurs. When everything is fine and there's no manic behavior going on because everything's going haywire. That's when you establish your risk procedures and you just execute on them when the volatility increases. So the second way for professionals to be unique in the marketplace is to manage the client's expectation and to create a risk-based safety net to cradle their clients' portfolios. Now, during the Trade Like a Pro course, you will learn to use risk management and the structure of the market itself, just like the endowments and hedge funds do, to protect your clients' assets. And in the process, you're going to be able to better equip yourself to manage your own expectations and the expectations of your clients. Now, thirdly, professionals create a rule-based practice. To trade like a pro, you must trade based upon a set of rules. Baseline rules create the structure that avoids cognitive biases. Because anything can happen, a bias blinds us to the possibilities of something else. If we hope and look for a bullish market, or we're bulls by nature, or we're bearish because we're worried about COVID and all stuff, and we're bearish, and what happens is you get tunnel vision and you only see the evidence that proves your point. We start to hope and look for that evidence of the one thing happening. And we often, our brain has the ability to see what we're looking for and dismiss all the other choices as non-existent. The structure for a rule-based probability system leads the professional to a series of hypotheticals. The trader is now prepared to act on any one of these hypotheticals, not just a single bias. This entire process is done by asking questions and then answering a few simple questions. A few of the tools used by professionals are context questions, binary questions, and cognitive dissonance. Let's take a moment and break this down and make it simpler. Context questions like, what has the market done? What is it trying to do? And how good a job is it doing? The answers to these questions help a professional better understand the landscape that the market is trading within. What has the market done helps give the historical context. What is the market trying to do gives the current context of the market within the market cycle. Where is it? And then how good a job is it doing helps understand where the strength is between the buyers and the sellers inside the context, to look at what that buying and selling pressure and where it's evident in the marketplace. So context questions help the professional first understand what's going on, what's the bigger picture, and then narrowing that down to the specifics of the actual evidence of buying and selling pressure. Binary questions help the professional avoid mistakes. Professionals ask binary questions like, is it trending or is it in trading range? Is the market going up or down? Is it strong or weak? Is it tight or broad? And they'll ask this on every bar. If they're trading 5-minute bars, they ask on every 5-minute bar. If they're trading daily bars, daily. If they're doing weekly bars, they ask it all the time. They just can't, what's going on? Where's the support? Where's the resistance? Where's the buying pressure? Where's the selling pressure? They ask these to clarify what's actually happening. But the other part of the side is just as important. What's not happening? If the market's doing this, it's not doing this. Again, keeping those options open and available to better understand what's going on. Binary questions rely on current information and avoid lagging indicators, which most analysis is lagging. This increases the professional's precision in their decision process. And why when you look at a professional's trading platform, it has very little information on it in terms of lines and graphs and all this stuff. They remove most of the indicators that amateurs and that the retail tend to look at. Now, cognitive dissonance. This is the ability of the professional to hold two contradictory thoughts at the same time. Because anything can happen, the next bar can be bullish or it can be bearish. Professional is not in the prediction business. Market timing has nothing to do with professional management. It's based on probabilities between multiple hypotheticals, any one of which can be triggered and put them into action. This removes the emotional side of the equation that too often straps and holds back the retail investor from acting in the marketplace. It allows the professional to be and act objectively in the marketplace. A rule-based process incorporating context questions, binary questions, and cognitive dissonance lead the professional to create the hypothetical that they want to work with. The hypotheticals allow a professional to prepare multiple possible outcomes. Not one, not a cognitive bias, but cognitive dissonance. Open to multiple choices. Keep all of it, anything can happen. When a hypothetical is triggered, it's acted upon immediately. Because like the pilot in the midst of a storm, they're following the instruments. They're not using their intuition or their feelings or their emotions or their gut. They're following the instruments. Professionals know anything can happen, and hypotheticals allow them to then act without hesitation in an objective, analytical, logical fashion. This is exactly where all the algorithmic trading comes from. It takes a successful process done manually and just turns it into an automatic, faster system to trade quicker. The same rule-based system that professionals follow manually, the computers automate. The third way for professionals to be unique is to create this rule-based process and then ask the right questions. In Trade Like a Pro, you will learn the same master trade process used by professionals, and it will better prepare you to benefit from the uncertainties that the market continually puts in front of us. Lastly, professionals protect their clients' assets. The professionals know that the markets are counterintuitive by nature. But we as humans, we act out of intuition and emotion. And because of that, decisions often get delayed or we hesitate to the detriment of our own performance. Professionals try in every way possible to remove that by becoming more objective. One important counterintuitive shift that they make is how they deal and concern themselves with profits. Professionals know that profits are like smoke. They're here today and they're gone tomorrow, because profits disappear. It took 16 months in 2019 and 20 to make the profits and only 4 weeks to remove them. Gone. Professionals know that profits should be taken based upon structure, not based upon price. Therefore, professionals take profits often because profits disappear. Now, this chart is often shown to prove that buy and hold strategy works. The argument says you will underperform if you miss the 25 best days in the market. Therefore, buy and hold. Now, the underperformance is true, but it's not the whole truth. This argument is never made by a professional. This chart is never shown by a professional because of the importance professionals place upon risk. Professionals measure risk using standard deviation that measures both sides of risk. The negative cost side of risk we call loss. The positive opportunity side of risk we call profit. Buy and hold philosophy guarantees the investor to get 100% of all the profits and 100% of all the losses. This chart we never see. It illustrates why buy and hold philosophy is flawed. It illustrates what happens by missing the 25 worst days. You substantially outperform. It's more than twice as valuable as not missing the best days, because professionals know that losses have a greater negative impact than profits have a positive benefit. Losses cost you more than your profits can make up. Now, professionals are skeptical about the buy and hold philosophy, and in many professional trading desks, you'll hear they call it the buy and hope philosophy. Losses can wipe out all your previous profits. Now, Charles Dow, the reason we call it the Dow Jones Industrial Average, the founder of the Wall Street Journal, on and on and on, his accolades go, wrote a series of articles in the 1890s that became classics. He wrote them for the Wall Street Journal. They were editorials, and they established the fundamentals of professional trading, and it's still followed today. He showed there that 80% of all performance comes from being in the right asset class, not in the right stock. So endowments and hedge funds, because of this, use an asset rotation strategy that protects their clients' assets. This is a way they can move from strength to strength from offense to offense, not from offense to defense, not from offense to cash, from offense to offense. Whereas most advisors and most retail clients use a fixed asset allocation. This places the portfolio on the roller coaster of profit and loss, up and down. So the fourth way professionals can be unique in the marketplace is to protect their clients' assets. And in the upcoming Trade Like a Pro course, you will learn to protect your clients' assets using the exact same tools that are available now to you that professional endowment and hedge funds managers use to protect their clients' assets. Now just imagine if you could raise more assets in a single year than you have in the past decade. Imagine if you could have more time to focus on the most important opportunities before you. Imagine if you could have a unique story that not only attracted prospects, but also assets, more assets your way. Imagine if you could be proactive in solving client problems and create a wow experience that separates you from all your peers. Imagine if you could avoid the next market decline and the one after that, like professionals do. And imagine if you could take your successful practice that you have right now and add to it the best tools that endowments and hedge funds use. And you can do all these things. Today, we've only scratched the tip of the iceberg of the content included in the 10th cohort of the Trade Like a Pro, which is now open. When you register, Module 0 is available right now. It's the pre-course prep for you to get started. The course includes 10 hours of live instruction over 5 weeks, 16 modules of online training on Teachable platform that systematically walk you through all the concepts and practices that you can watch over and over again. Weekly live Q&A sessions. We're going to sit down every week over the 5 weeks and answer your questions. All the live instruction and the Q&As will be recorded, so in case you miss one, you can attend it. You can watch it at your own leisure. All the tangible deliverables give you the ability to incorporate them immediately into your practice. So there's not just concepts. I don't believe in just delivering concepts. I want to deliver something tangible you can use and apply, an exercise you can do, something you can make it concrete. It's not just ideas. During the course, you have 24/7 email access to get all your questions answered. I'm going to treat you just like a coaching client during this 5 weeks. We're so confident in the value of this content, we're offering a 100% satisfaction guarantee. It's endorsed by Canadian Securities Institute, who applied for 20 continuing education credits with IROC. And since the course includes more than 27 hours of actual instruction and additional content, we anticipate the approval soon. And if you're looking for whether or not it applies to your CFP, you can use the CE credits with your CFP designation also. The following are statements from previous alumni of the Trade Like a Pro course. And like you, they reflect the variety of the needs and desired outcomes. If you want to gather more assets, if you want to capture more opportunities, if you want to separate yourself from the herd, if you want to take back control or be more proactive or minimize your client losses, or just fine-tune your current practice with more professional tools, this is the course for you. You can register today. Discounts are available for CSI members and designation holders. Now, we're going to open up the Q&A at this point here, and Marshall's going to oversee this in terms of asking the questions. He's going to select the question. If you haven't already put your questions into the Q&A, If you have some questions about anything, put it in there. We'll take some time here now. We'll use the rest of our time to sort of answer your questions. All the questions will be answered. Any question that we don't get time to answer during the Q&A here today, we will then put out an email, the additional questions out in an email to you to answer them by email to you later. So you're, so Marshall, if you want to come back on, we'll, I think let me see, make sure I get him back here. Marshall, do you need to?
Okay, great.
Okay, good.
Thanks. Okay, Lloyd, that was great. Thank you very much for that introduction and sneak preview to the course. We do have some questions. After we take your course, will you have a model portfolio for us to use or follow to help our clients by following your investment process?
If you already have a investment process, the tools we're going to show you are investment agnostic. They're discipline agnostic, investment philosophy agnostic. Doesn't make a difference whether you're a value investor, a growth investor, whether you buy stocks, whether you do mutual funds, whether you do ETFs. It's agnostic to that. This is an overlay on what you're already doing, the process you have. If you don't have a model portfolio, if you don't have a process, I'm going to show you a model that you can use and adapt. That's a great process to use, the one I've used and others have too. But if you already have something you're comfortable with, we're not trying to say you got to change what you're doing. You can keep exactly what you're doing and use this as an overlay on top of what you're already doing. We're not trying to teach you and change you from being a value investor to become a growth investor, or from a growth investor to become a value investor. Your philosophy is your philosophy. These are just institutional concepts and tools you overlay on top of all the different disciplines, all the different instruments, all the different tools that you can that you're currently using. So yes, we'll give you a model, but you can use your own that you have too. You have the choice of either one.
Great, thanks, Lloyd. Here's another question. What did you do that helped you to avoid 90% of the recent correction in 2020? Did you sell out to cash or other ways?
The mastermind group was made up of individuals just like yourself that are retail advisors that manage portfolios. They've been with, some of them have been with me since 2009 on as we started the early counterintuitive investing group. And basically the tools were, when you see them, the structure of the market identifies where the market is no longer doing what you went into. When you go into a trade, you're expecting it to go in one direction or the up or down, whichever way you're buying long or short. When that reason for being in the trade is invalidated because the structure's been broken, the channel has been broken, something's been broken, then you exit. So the tactical portfolios exited very early in the market as the market broke its initial structure. There was a reason why it was bullish in the first place. So the first portion of the money came out. The rest of it came out when the structure was broken on the weekly chart to take out the core portfolios, and they scaled out. The most tactical of and the oldest of the participants avoided as much as 117% of the correction by not only avoiding the loss, but by then using gold, treasuries, and other investments by asset rotating into other asset classes and picking up positive alpha during the decline in one asset. When the stocks were going down, gold was going up, and they picked up positive alpha. So they went out of one set of ETFs and went into another ETF and made money. The average of the group was avoided 91% of the correction, and the newest member of the group, who had only been in the group for 30 days, avoided 68% of the correction. So it was a phenomenal success in all accounts. And the members have been avoiding the corrections up to this point in time, as do all professionals. Goldman Sachs doesn't lose money when the market crashes, guys. I mean, the market crashes now, but it's not Goldman Sachs losing money in that process. The endowments don't lose money. The endowments have gone for like 30 plus years, never having a down year, simply because they use the tools we're going to show you to identify where the structure is, and then identify when that structure is broken. Because the market has a specific structure, which, to be honest with you, is easier today than it was in the 80s and 90s, because with computers, the computers follow the structure even closer than humans do.
Okay, great. Thanks, Lloyd. We have lots of questions, so here's the next one.
Yeah.
How does your training or the Trade Like a Pro course fit in with the more holistic sort of advisory approach that more and more advisors are taking these days?
Oh, it fits in perfectly. This course is one of 4 that we hope to lay out over the next year or so. The first one is the relationship as a marketing is a relationship conversation, which is the relationship, the front part of bringing in the money. Then there's the second part, which is the practice as a business architect, where the practice management part about how to run the business. This is the third part of the whole process called Trading Like a Pro, where you get your investment management process. And then the last part is business development and planning called Future Proof Your Life and Practice. All 4 modules are part of that holistic approach to the investment process. This fits in perfectly as a part of it. You've got to have both a marketing engine that brings money in. You've got to have a practice and a team that can manage and exceed the client's expectation, deliver it. You then have to have an investment solution that exceeds what they were expecting to do, manages and protects their assets, and gives them the risk management they need to go forward. And then you need to have a business development model about how you're going to plan and grow your business as you build out. So this fits in perfectly into that holistic approach because we believe we've been teaching that whole concept for 30 years now.
Great. Are options part of the risk management process?
We won't talk about options. Options used to be the primary portfolio insurance that institutions used, no longer. Options and futures were their primary portfolio insurance. They would put an option on at the end of the day. I remember for years, we would put an option on Friday afternoon for the whole portfolio to cover any losses over the weekend. Not done anymore today. Today, the ETF marketplace gives the professional a perfect hedging tool. Unlike what you hedged, you sort of tried to hedge the mix you had of your assets you had in your portfolio. Now you can specifically hedge every pie slice in your allocation. So we're going to show you what's called institutional hedging, how it's done, and you can do the exact same thing with ETFs. You can do it with mutual funds. You can do it with all the different vehicles that exist to do it. You don't have to do it with options, but we will discuss options, and they have a place, and we'll talk about how they fit in. But it's no longer what it once was. I mean, if this course was 20 years ago, when I talked about it, then options were a major part of it. Today, it's almost a non-existent vehicle. Most people don't even have options license anymore. Don't need it because the ETFs gives you a purer play than you can get with the options.
Yep. Great. Does the information work as effectively with new advisors versus more tenured advisors?
It has no bearing on the length of the advisor as much as it does on the trading psychology of the advisor. One of the first things you're going to do in Module 0 is what's called a trader assessment. It's just like if you've ever done a DISC or a Myers-Briggs thing. It's an assessment specifically designed to see what your trading aptitude is as a trader and where your strengths are and where your weaknesses are. And we're going to use those strengths and weaknesses to better help you go through the 5 weeks in adapting to remove your weaknesses and enhance your strengths. Some of the oldest tenured advisors can be constrained by beliefs that they hold to be true that are just constraining beliefs and are not enabling. Whereas the newer advisor who doesn't have all that baggage of stuff doesn't have a problem. Some people just are buy and hold by nature. They just believe everything buy and hold. Just they thought that's how Warren Buffett made it. Warren Buffett didn't make his money buy and hold, folks. Warren Buffett made his first billion as a hedge fund trader. He looked more like George Soros or Jim Rogers. He was short and long, multiple currencies, multiple markets. That's how he made his first $1 billion. And if you look today, he's more than happy to get rid of stuff and hold stuff. He's becoming more of an asset rotator, like the big professionals are, because his performance was lagging the professionals the last decade. Because computers, what we're going to talk about, one of the big changes, the change that computers have made. When you see the change they've made in the marketplace, and how you've got to adapt, you'll see why you've had such a difficult time in this decade equaling or outperforming the market. And you had none of that problem in the 80s and 90s and early 2000s. But this last decade's been difficult because that chart I showed you with all those trading ranges makes it much more difficult to add value over and above what your professional peers are doing. But now you have the tools through the course to do that.
Okay. Is the course targeted towards shorter term traders, or is it more for portfolio managers or long-term investors?
We're going to talk about the use of time frames. You're going to decide what time frame you want to invest in. This process works whether you're a sovereign nation and use a monthly chart, all the way through professionals who use weekly and daily charts, to day traders who use hourly and 5-minute and 15-minute charts, to scalpers who use second charts. So I said the overlay has no bearing on what time frame. You pick the time frame you want. You say, I really want to only look at this very rarely. I want to be a sort of on a sideline. Then great. Well, use a weekly chart and look at it once a week and make your decisions. You've got somebody else taking care of the marketing side and relationship management side of your business, and you want to trade. One of our mastermind guys trades full time, 6.5 hours a day, sits at his home with 6 monitors up in front of him, trading the markets live in real time. He's the exception to the rule, but you can do that if you want to, if you have that thing. I had on my team, I had a professional full-time trader that traded. Dustin did our trading for us. He was a trader for us. So you can do whatever you want to. There's no limitations here. It's what you want to do and what fits for you. You may start off with one time frame, and change your time frame over time. You may become very slow in the process using mutual funds or ETFs and then trade over. You may start off with stocks. You can adapt how you want to. The system, again, is agnostic. It's the process you got to put in place that the professionals use that overlays on top of it.
Okay. Well, there's I guess a follow-up question to that. The question is, I use mutual funds. Do you see benefit for an MFDA advisor like myself to take this course?
Yes. It's just as important to know when to protect your mutual fund assets from a slide down. The problem with mutual funds by themselves is they are by nature restricted under 4 major restrictions. They must be fully invested. They must hold less than 5% in cash. They invest typically in stocks and bonds only, and they never liquidate. They invest the money. All the money goes in immediately to work. That's the buy and hold philosophy. Now, that's where the buy and hold philosophy came from. It came from the mutual fund industry because it didn't exist prior to the mutual fund industry. Charles Dow in 1890s told everybody that they had to be more, had to rotate. The mutual fund industry, because of the constraint of the actual rules that they have to abide by under the Investment Company Act of 32 in the States and the Investment Company Act in Canada, require them to stay fully invested all the time. And that philosophy became pervasive in the retail marketplace. It's basically how all investing is done in the retail marketplaces, some form of a mutual fund type approach. So you can still use that, but you still want to know there's a point at which, do I really want to take all the standard deviation on the loss side when I can avoid it? And the answer is no. So it works for an MFDA advisor. Some of our members in the mastermind group are MFDA advisors only, and they basically use the same decision process to rotate their mutual funds the same way the others are rotating ETFs or stocks or other instruments that they are using. So yes, it works for both IROC and MFDA, or whether you're a securities licensed or whether you're a planner licensed in the States, either way.
Great. Do you need to be able to short the market to benefit from the strategies that you're going to be referring to in the course?
You don't. There's always another asset class you can move into for a positive alpha play. Most of the profits made during the 2020 correction were made by going positive in a long in a gold or treasury security rather than going inverse in SH or DOG. Now, I'm gonna be honest, if you can go inverse, that's just better for you. And some of the firms are now opening up that territory again for advisors. And if that's the case, then you've got just an advantage. You just make more. Those who can go inverse just have a better performance on that too. But you don't have to. You can use going from long position in one side to the other. The market tends to make a move from intangibles to tangibles and from big cap, mid cap to small cap, and they make these shifts back and forth. You can make that move from asset class to asset class without having to go short. Short just gives you a better advantage in getting more of the actual pure play faster. So a person who can trade SPY on one side long and then SH on the other side short can just can more closely align what Goldman Sachs is doing when they're going long on one side and short on the other side. But it's not necessary. It's not required.
Okay. What specific tools are used? For example, Morningstar Advisor Workstation, Bloomberg, Excel models, et cetera, et cetera.
As I said earlier, all the technology, the process is all technology agnostic. Whether you use Thinkorswim or whether you use Morningstar or whether you use your Quotron machine or Bloomberg or whatever you have it on your desk and what you're using right now, you can use. There's also tools on the internet that are free. But if you don't say, well, I don't have any tools, well, great, we'll show you some tools you can use. So you can use what you've got. We'll show you tools that you can add on top of that to maximize it. Or if you don't have any tools at all, we'll just show you what you need to do. Many of the tools today are free and available online, or for a small subscription charge, you can get access to. Some of the best trading tools right now are available. One of the best platforms is the TradingView online right now, which is basically investing.com's other side of investing.com. It's the TradingView.com. It's a great platform to do some charting with and everything else. So we'll show you all the tools that are out there that you can look at and do. And they vary from very professional with TT at one end all the way down to using investing.com or stock charts on the other side, or what you have at your firm. And most firms and most practices have some form of charting information there somewhere, and you can use that. And we'll just show you what if you want to add more, you can add more. But the technology is agnostic. It's not dependent on anything, one thing.
Okay. Are dividends and taxes important to the process? Do you consider those elements as part of your process?
Yes, we do. But understand, professionals are more afraid of an actual real loss than they are the cost of a commission. The cost of a commission is this. The cost of a dividend is this. The cost of a loss is this. And too often, people let the tax tail wag the dog and end up losing more in capital loss than they would have had they taken the trade. So that's again where we're talking a structural shift rather than just making trading like you see the average day trader who just trades way too much and ends up losing all their portfolio. We're not talking about that. That's not what this is all about. This is about what professionals do in terms of using the structure of the market to determine the bounds at which you need to be in, at the bounds at which you need to make a change. So taxes are never an issue as long as there's some return. And I'll be honest, nobody should mind paying taxes because taxes mean you made money. The problem is at the end of the correction, after the 35% loss, nobody had made any money. They didn't have to worry about taxes. They'd lost all the last 12 months of performance. If that had been December 31st, it would have been an ugly year. Now, the advantage is that loss was not temporary. We think it's temporary because the market went back up. That loss is permanent. We're going to show the professionals view all losses as permanent losses, because had they not lost it, they had a cost basis down here to write it back up again. You just missed the opportunity of the 28, 30% rally that happened because you were down here with a lesser money. Had you profited up here, you'd gone back in and made it again. And that's the advantage. So yes, we take taxes, dividends, trading costs, all that into consideration. Inflation, all that into. We used to quote as an institution, we always quoted after tax, after inflation, after fee returns to clients. That's how we actually measured our performance. The net dollar that the person got to deal with. That was the real return. And there was a movement at one time to make that a law, but nobody really wants that. We didn't mind it. We had a good enough number. We showed it that way and said, compare it to your peers and see what they like.
Okay, great. Okay, we got a couple of more minutes, so maybe a few more questions. And if we don't get to, if Lloyd doesn't get to your questions, we'll have written responses to them after this webinar. Will you teach how to set up effective stock screens that help with buy side and sell side decisions?
We're gonna look at the difference between fundamental analysis, which is used to identify what to buy, and technical analysis, which separates and identifies when to enter and exit. The two are not separate. They're one part of the analysis. They're two parts of the analysis process. Analysis is not, you're not a fundamental analysis or technical analysis. If you're a trader, if you're a professional trader, you're a both. So we're going to show you the fundamental side of how you need to set up your screens that you do to identify what you want to buy, what you want to look for. We're going to show you both approaches, the top-down approach and the bottom-up approach. What we actually believe is a double, where you're doing both. That's the best approach. But we're going to show you all three alternatives, and you can decide which one you're most comfortable with. So yes, we'll show you those processes that are part of the fundamental side and the other tools you can use there to help fine-tune that. At the same time, we're going to merge that data feed into the technical side about now that we know what we're going to buy, when do we enter? And how do we manage it and how do we exit it? And that's where the two together come in play. We're going to also look at some changes that have occurred in the fundamental equation because of the massive move to intangibles and companies that have no tangible value that shows on the balance sheet. Companies like Google and Twitter and Facebook and these kind of things that are radically different and radically changing the fundamental analysis side. We'll go into detail about how that affects that and what you need to do to adapt and change for it.
Okay, well, maybe one more question. It's a longer one, but it's an interesting question. Do you see computers slash AI, artificial intelligence, altering the fundamentals of investing, which traders or asset managers tend to look at when making decisions on a portfolio, to the point that those fundamentals may not be as effective as they once were?
This is a great question. This is an entire session in one of the entire modules in the work that we got here. So let me give you a little sneak preview. Computers, as I said in the webinar just so far, are the greatest, most radical transformation that has occurred in the markets to date. It has radically changed the entire investment stage. We're not in the same world. This is one of those cases where it has changed, and it's changed permanently. Let me give you an example. In the past, the market tended to look, because of the buy-side bias that we as humans had. So if you were I got into business in 1984. 1984, a client, human, called a broker, human, who called a trader, human, to buy 100 shares. On the other side of the world, a client, human, called a broker, human, to call a trader, human, to sell 100 shares of XYZ. And on the floor of the exchange, the two traders waved hands at each other and 100 shares transacted. It was all humans, all had a buy-side bias and wanted the market higher in the future than it is today. And that was why through the 80s and 90s, from the 30s, 40s, 50s, 60s, 70s, 80s, 90s, 2000, the markets had a 65% bias toward the buy side. 60% of the bars were buy-side bars. 30% of the bars were trading ranges, and on average about 5% or so, 10% or so were bear bars, bear trends. That's changed. That chart I showed you from 2015 on, now 60 to 70% of the bars are trading ranges. 30% are bull markets, and the same 5 or 10% are bears. Now, in the old days, all boats float. You were right 65% of the time. You were right because the buy-side bias made you profitable. Now you're only 30% of the time right on a buy-side buy and hold philosophy, and you're 70% either not making any money or actually losing money. It has radically changed the whole world. the entire industry is struggling with this whole thing. This is why people are scared. They're not making the returns you once made. Because without a more dynamic approach to your investing, a more proactive approach, you're going to be losing more than you're going to be making. You're no longer going to have a 65% of the time you're going to look good, whether you did anything other than just sitting there and had the boat float. Now you're going to be 30% of the time looking good, and 70% of the time they're going to be asking, what you doing? Why am I paying you? That's not good. So yes, we got a whole module to explain how computers, how it happened, when it happened, why it affects you, and how you deal with it. Because it's the biggest thing you got going against you. AI is not your concern, because the AI thing is not about asset allocation here. They're making money in scalping. The AI right now, most of the algorithmic trading is all market making on a very fast basis, and it's creating liquidity, which is actually a good thing. It allows us to go through crashes and rebound faster from the crash than we would if we humans were involved. We would not have rallied back from the 2008 crash as quickly as we did. We would not have stopped where we stopped on the 2020 crash. It stopped at a support line that was known and already sitting on the chart before it ever got there. It was a known place where the market was most likely going to find support, and it found it and right back up. Had it been humans only trading, we'd have blown through that with just emotion and fear and everything else. That's why, if anything, the computers have added more structure and in some ways greater security. But what they've also brought with them is greater volatility. That volatility chart I showed you, the last decade, the peaks of the 29, 87, 2008 crash all happened at 90. The 2020 crash only peaked at 80. Didn't get back to the old highs. But the difference is all the years, the decade prior to this decade here, last decade, the average non-peak volatility was in 10 to 12 to 15% range. It's doubled in the last decade. That's the average non-peak, the average. That means it's twice as volatile and twice as risky for you to take a trade today than it was just 10 years ago. And nobody's adapted to that. Nobody's changed their risk parameters. You're still putting your stop the same place you put your stop 20 years ago when you were in the business. And that's a mistake. And that's why you're getting stopped out more often. That's why you're getting triggered and whipsawed more often, is because you're not accounting for the increased volatility. That's only going to get worse over time because computers like what happens. What volatility is volatility is the amount of order flow in the order book, in your DOM, in your depth of market on your computer. You see all the bids on one side, all the asks on the other. When it's thin, when it's thick, first of all, it can absorb all the market orders that come at it. But if it gets thin, a big order comes in and the price jumps because it eats up all those prices. We're going to show this to you in detail so you understand it better, so you can explain to your clients. Because volatility is a fearful thing, but it's also a great opportunity because it can be in your favor just as much as it can be at risk. Right now, without the knowledge that you need, it's on the risk side for you. For the professional, it's on the opportunity side. And I think you'll find, I'll make this promise to you. As I said, this is satisfaction guaranteed. You're going to have more new content. If you haven't had a chance to look at the testimonials, look at the testimonials from the people in the past. We're going to show you stuff you had never seen. I had been in the business for 16 years prior to going and working professionally with a hedge fund. I learned more in the 3 years I did that than I knew in the previous 16, and I managed $1.5 billion at one time and thought I knew, and we had done a huge return over the entire period without a losing year. And I thought I knew everything. And I realized, hold it, man, I'm missing a whole boat. There's a whole part of market of the trading side over here I missed. I didn't understand the hedge fund side. I understood the institutional side. And what we've done now is we're going to put both of these together for you. We've always drawn from the institutions, but not all the institutional tools. but we've never been able to draw from the hedge fund side. Because unless you got trained by Goldman Sachs or by Bridgewater or somebody, you don't know it because they don't tell that stuff. There's no books written about this stuff over here. We're going to put both of those together and show you. And that's really where the set. It's not about your CE credits, folks. The value to your practice, if you just avoid the next correction, this has paid for itself 1,000-fold over. If you just miss some of the next correction, I'm not saying miss the whole thing. If you just missed more than you missed, you'll that's the advantage. And I wish I had known all I know today when I started back in 1984. I'll tell you my story. If you can go on the in module 1. The first thing is the introduction to the instructor. There's a little video there, and I'll explain to you some of my backstory and all, and you can see. But there's a whole story about where I learned this. If you haven't read it, you can go to my blog and read some posts on the blog there early on. Talk about Cantrell and Ralph and Cantrell, 2 traders in my office that taught me lessons I didn't know. I didn't know about this side here, and they gave me a view of it. I was lucky early on to understand both sides were necessary. You had to have fundamental and technical together, and it allowed us to have a much better, more comfortable practice and an easier ride for our clients. And I want to share that with you. I want you to protect your clients' assets. I was proud of the fact that the Mastermind Group was able to protect so many of their clients' assets relative to their peer groups. So I didn't get to all the questions, and I apologize, but here's what I promise. Give me a few days to answer them all. I'm going to put them into an email. We'll shoot it out to you. But if what you heard here today is compelling enough of interest to you to give it a chance, you got nothing to lose. If you get in and say, hey, this is just not for me, we'll give you your money back. I don't want to try to give you anything you don't want. If this is not for you, great, we'll let you go. But I promise you, you will find stuff you're not going to read in any book or in any course anywhere. And we're going to take you through it step by step, systematic. You're going to have 6 months of access to the content from the time you start the course for 6 months to go back through it, bring your whole team through it, everybody understand it, everything else together, and work it so you can see it. And we're going to continue to keep you in the loop, what's going on while you're in the process. So I look forward to working with you. Hope you can register. If you register today, you can go ahead and get started. There is some pre-work. There's 2 books I recommend you read prior to the course. So the sooner you can get those started, the better. There's a trader assessment, and there's some actual tools, some exercises you need to do ahead of time that we're going to use during the course. We just want you to do them ahead of time because you're going to have plenty of stuff to do. We're going to go for 2 solid weeks. Each week we'll roll out about 4 to 5 of the modules. Every Monday will be a call. We'll do the call, and then after that call, we'll go from there and go through the process through the week. You'll work through it. We'll have another Q&A session later in the week to answer any questions, help you through it. The next week, we'll do another live call. It will be followed up by the modules going out. You work on the modules thing, and we're going to have the Thanksgiving week in Canada here. We're going to use that third week, which is Thanksgiving, to be our sort of catch-up week. We're going to have a Q&A, a live 2-hour instruction session, and a Q&A session during there, but it's a chance for you to catch up if you fall behind in any way. Then the last 2 weeks, we're going to close out with the last modules. The third week is the most important week. It's where we actually show you how professionals prep, execute, and manage, and exit trades. So that's the real meat and potatoes in terms of what the professional information is. We're going to look at there, and then there are 3 modules there. One's going to be all about preparation, one's all about execution, and the other one's all about management and exit and targets. So look at the course curriculum is available on where the landing page you went to register for this has the course curriculum. It's I don't know, a bunch of pages long. There's a whole bunch of material there. Look through it. It shows you all the content that's going to be available there. I think you're going to find it valuable. And if you have any questions, please drop us an email before. We're happy to answer any of your questions at courses@lloydwilliams.co. Courses@lloydwilliams.co, not com.co. So I hope that's helpful. Marshall, thank you so much for facilitating the Q&A session here and everything else. And ladies and gentlemen, it's been my pleasure to meet with you here today, and I hope to see you in the course. And thank you much, and take care of yourselves.